Imagine I have a rare coin, but you think people are collecting that coin because they're deceived by false information. However, you do not have that coin to sell. What you do now is to borrow that coin from me and then sell it for $200. Because you borrowed the coin from me, you need to return the coin to me, let's say, in 2 weeks. A week after you sold the coin, the bubble popped and now the price is $100. Now, you have to go to the market and buy the same type of coin at $100. Then, you return the coin to me. Remember, you borrowed the coin from me, not any money. Therefore, you have to pay me back with the same coin, not the money because I want the coin back. Not any money from you, as I have never lent you any money. Now, as we trade futures, you know that not a single crypto is exchanged between different hands. We're only playing the game on the price of Bitcoin, not Bitcoin itself. Let's say you take a short position at $70,000 using your $10,000 fund. Tomorrow, the price drops to $63,000. This is a 10% drop in the price. Because your position was worth $10,000, your gain is now $1,000.
Let's say you buy 2 units of Bitcoin at $70,000. What if it drops to $50,000? You would be losing $40,000 now. You either have to stop out or hold them for an indefinite amount of time to gain profits. On the other hand, futures allow you to multiply your position through a tool called leverage. If you have only $10,000 worth of Tether but want to bet $20,000, you have to leverage your position by double, or 2 times. Let's try a simple example. You invested $10,000 and leveraged your position to $20,000. The next day, due to a nuclear war between 2 hostile countries, Bitcoin drops to $35,000. Because the price dropped by 50%, your position would be losing 50%. 50% of $20,000 is $10,000. You'd lose everything you have. When trading futures, we recommend people to stick to stop-loss points given by our model. A stop-loss point literally means a price point at which your position is closed. You do this to avoid further loss. Unlike when you hold spot assets, your futures positions can be liquidated. Liquidation means that your position is forcibly closed by a broker or an exchange because you no longer have money to absorb further loss. I once saw our model telling us that the price was likely to fall, so I took a short position. At that time, I had $5,000. Because the signal that our model gave us was very strong and convincing, I decided to multiply my position by 4 times or 4x, thereby making my position worth $20,000. The price dropped about 7% and I gained about 28%. 7% of $20,000 is $1,400. $1,400 is 28% of $5,000. It's similar to taking a loan to buy a house. A $1 million house would cost you $500,000 if you decide to fund the rest from a bank loan. Although you spent $500,000, the total amount of cash you hold becomes $1 million. If the price of your new house jumps to $1.5 million, your gain is $500,000. $500,000 is 100% of $500,000, which was the actual amount of money you held and spent. Same thing. Though we are not actually taking a loan from an exchange, we increase our total position by taking leverages. For example, your budget is $5,000, but you want to bet about $10,000, so you leverage your position by 2 times or 2x. If the price of a crypto goes up by 10%, your gain would be $1,000 instead of $500. But there's risk to it, so always make sure to set your stop loss.